Greetings, accounting students. A useful starting point for this is to place emphasis on the accounting equation, A equals L plus OE, because this underpins the whole premise of the twofold effect of financial transactions. If we look at Newton's third law of motion, for every action there's an opposite reaction. This applies to the twofold effect of accounting transactions. For instance, for any transaction that affects the bank, there's an opposite effect somewhere else in the accounting system, so that after that transaction has been recorded, A will still equal L plus OE, which we will demonstrate in this video. So what I'm going to do in this clip is to focus on transactions that we know affect an asset or a liability or owner's equity. I'm going to park revenue and expenses for a part 2 of this video, just to keep this video brief, so consider this video part 1. So let's look at transactions that we know affect at least one asset and look at the twofold effect. Obviously, there'll be an increase or a decrease in the balance of the asset, and then we need to ask ourselves, how was that asset funded or reduced? Now, it could have come internally from the owner, and therefore that brings into play capital and drawings. It could have been externally funded, so we could have borrowed funds from a bank in the form of a loan or a mortgage. It could have been funded from within the business, so that's where we're swapping one asset for another by using cash at bank. Or we could simply be receiving cash from our accounts receivable from a previous credit sale. So here we have 4 transactions that we know affect an asset. And so in a moment, it'd be good practice to pause the video and identify the 2 accounts that have been affected by examples 1 and 4. And with examples 2 and 3, you're going to have a 3rd account because of the GST effect. So let's jump out of this and go into a spreadsheet and record these in our balance sheet one by one, just to highlight the twofold effect. So the first one that we had was the owner has contributed a vehicle with a fair value of $50,000. So we know that we've got more vehicle. So we go to our assets section, currently has a balance of $10,000, and we're going to top that up by $50,000. So now we've got $60,000 worth of vehicles. So then we need to record the twofold effect. So how have we funded that vehicle? Capital. The owner has made a contribution, which increases their residual claims. So that is also going to go up by $50,000. Assets still equals L plus OE. Second one, the business has purchased some inventory on credit for $20,000, plus there's a GST effect. So we know that we've got more inventory. So we're going to go 10,000 plus 20,000 gives us 30. Now this GST clearing balance represents the GST that we've collected from our customers, and that represents an obligation to pay the ATO off in the future. So when we pay GST, this actually offsets that GST balance. So that 10% GST will reduce our balance owing to the clearing account. So we're going to minus 2,000 from that, take that down to 8K. Now, in terms of the total of that, 20,000 plus 10% GST, that's 22,000. So therefore, in terms of our accounts payable, we need to basically report this by topping that up by 22K. So that's now 32. And again, assets still equals L plus OE. Third one, the business has purchased equipment for cash for 2K. So this is pretty similar to that number 2. So we go into our assets, our equipment account. We're going to top that up by 2,000. And then we, in terms of the twofold effect, how do we fund that? Well, I'll get to that in a minute, because first of all, we need to reduce the GST balance, just like we did for that inventory. So now that's going to reduce that to 7,800. We're taking 200 off because it offsets the GST we owe. And then if we add the GST and the value of the equipment, we've funded that via the bank. So we're going to go 10,000 minus 2,200 gives us 7,800. Alrighty. Final one. We've received $1,000 from our accounts receivable. So we've had a credit sale in the past, and now our credit customers are settling their debts. So if we go to the accounts receivable, this is actually being reduced by 1,000, and our bank balance is going up by 1,000. We're swapping one asset for another. Okay, let's go into liabilities. So with our liabilities, again, obviously, if we know one liability is affected, that will change the balance of that. And generally, the other account affected will be an asset, but not always. So examples would be when we're borrowing funds from a bank, a loan or a mortgage, or we're paying off some of the principal, not the interest. The interest is the cost of that debt. That's an expense. We'll deal with that in a future vid. If we're buying inventory on credit, that's going to increase our accounts payable balance, or if we're settling that debt, that will reduce it. And there's obviously some GST effects of various transactions, which I've just dealt with before. So I'm just going to do one example for this one. The business has borrowed $50,000 from ANZ. So back to our spreadsheet. Again, we know that a liability is changing here, so because we've got some external claims on the assets that are increasing. So if we go over here to our loan account, we're going to report that as 50,000. And then where are those funds going? Presumably in the bank account. So we're going to top that up by 50,000. Alrighty, let's move to owner's equity. And again, as I said before, in this vid, I'm not worrying about revenue and expenses, just to keep things brief. We're just looking at owners' contributions or withdrawals. And again, this links in with the entity assumption. So an example would be, I've already done a capital contribution. Let's look at the opposite. The owners withdrawed some inventory valued at 200 cost. That would be sold for 400 plus the GST component. So what figure do we actually report here in the balance sheet? Well, because of the accrual basis assumption, we don't report revenue until it's earned, and the sale was never made. No customer ever gained control of the goods. So therefore, we don't need to worry about the sale price effect. We focus on the cost price effect. So back to our spreadsheet, we've got inventory. Our balance is going down by 200, so that's 29,800. And this affects our owner's equity. Drawings is actually one of the few negative figures you'll find in the balance sheet. So this transaction is reducing the residual claims of the owner on the assets. So we're going to report that as a negative figure.